Hi, do you ever get involved in risk-sharing conversations, either as the buyer or the seller, but don't quite know how to construct a reasonable risk-sharing model? Today I want to give you a template for risk-sharing. I'll explain why risk-sharing needs to be deconstructed from price and value, and then I'm going to give you a template for risk-sharing. Let me give you my conclusions right up front and then I'll explain how I arrived at them. Number one, make sure that your value that you're actually delivering is excellent. Number two, make sure that the price for that value is fair. You do that, you remove any conversation around discounting and risk sharing being confused conversations. Number two, make sure that you've really created, that would be number three. Number three, make sure you've really created a case for change at all with the client. Do they even need anything ever? Make sure that case is really well established. Number four, make sure that your value has been really clearly explained relative to that. So that is, you got good stuff, it's well priced, they really need something like what you do, and you've sold what you're going to provide really, really clearly. If you've done those four things, you've created a case for your product. Next, assess your own appetite for risk, and I'll give you a model for that. And then finally, sell that risk multiplier. Let me explain a bit about how I arrived at those conclusions and what you can do. Then at the end, I'm going to give you a risk sharing template. All right, so the first bit's pretty clear. Make sure you've got good stuff. If you're selling services or you're selling product, the stuff just has to be really good. Just fix that. Number two, make sure the price that you're charging for that stuff is absolutely fair. And the reason we need to do those two things is it's really quite easy for a buyer to confuse discounting and risk sharing. If they say to you, what's your skin in the game, make really, really certain that that's not a conversation for we don't quite see the value and we're looking for a way to discount it. Because quite frankly, if that's the conversation, you've got something bigger to fix. By that I mean, again, that confusion between risk sharing and discounting. Let's get the discounting right off the table. So, good stuff, fairly priced in the market, really important start. Now, all of that though is just you. Let's go to them, the buyer. Number three. Third thing we need to do is to make sure that the case for change has been really well established. Again, otherwise it's a version of that discounting conversation in that, look, maybe your stuff is good and it's fair market priced, but I'm not even really sure I need it. Therefore, what's your skin in the game? Wrong conversation. If they're not sure they need it, then maybe they don't, or maybe you've sold really badly. Go back and fix that. Number four. Make sure that you've sold your version of the answer to that need. So you've created a need and it's now clear they need something from somebody. Now go and sell your something and make sure you sell it well. So if it's good stuff, well priced, they really need something like this and you've sold your something really well. If all of that's been done, then the discounting conversation is off the table. You want my stuff. All we're really talking about is now a cash contribution from me. Because if you want my stuff, you'd buy it, except you don't have enough cash. So now, I'm actually an investor, I'm not a vendor. That's where we get into step 5. But again, let me pause. Now I'm an investor, I'm not a vendor. If you need, I've got good stuff, it is good, and it's fairly priced, then the risk sharing conversation is actually now an investment conversation. Now that I'm an investor, I can behave like an investor, not a vendor that's scrambling for business. Deal with all that stuff first. Now, scrambling for business versus being an investor. If I'm an investor, what am I going to look at? Well, what are the risks of this completely going pear-shaped? What of that can I control? What's my return if those risks are dealt with? That is, I'm looking at the downside and the upside. What's the chance it's going to go pear-shaped? And if it doesn't go pear-shaped, but it actually works, what return do I get? And we need to factor for both. We need to factor for the risks, and then we need a return if the risks don't fire. And then finally, step 6, we need to sell that multiplier, whatever that is. Now I'm going to give you a template, and in the template I'm going to use an example of a 3x multiplier, but I'll build that up a little bit. Let's say that that's the right conclusion after step 5. Now we move into step 6, sell the multiplier. You arrived at that by a piece of logic. Walk them through the logic. As an investor, the way I view this is as follows, and then sell them on that multiplier. Along the way, now this isn't really a separate step, but along the way, make sure that you conduct the conversation such that if it all falls apart and they say, look, I still love your stuff, but you're being unreasonable, or you're looking for a too high return on your investment and I can't allow for that, then you need to be able to fall back to, okay, let me just sell you my stuff and let's go pitch to another investor who's going to fund it other than me. 6 steps, the net of which should be you and the client reaching an equitable arrangement on risk sharing that isn't based on desperation, but on fair value and now a fair return on your investment. Now let me show you the template for risk sharing and how to arrive at those, at the actual multiplier. So now let me show you the template that I used to calculate a risk multiplier. Again, the basis is we're no longer having a discounting conversation. We've worked out that they need and they like what we do and it's fair market price and it's a great product or service. So if I no longer have to discount, I'm not in vendor mode, I'm now in investor mode. And so the non-desperate investor is going to take a dispassionate view because the vendor, who may well be desperate, doesn't need to anymore. Okay, so forgive me, I'm going to refer to my notes here because I want to get the precision of this right. I'll put all this up here as I give you the details, but again, forgive me, I'm going to refer to my notes here. I'll put a copy of this spreadsheet in the show notes so you can get it as well. It's not a complicated spreadsheet, but it will help. It's quite a nice little template. Okay, first we want to assess what the risks are. And I want you to start with understanding the risks of your own work not delivering the value, or your own product if you're selling products, not delivering the value. Be real. No product and no service ever has a zero risk of just failing to deliver the value that the client needs. Don't say that, oh, hang on, didn't I sell all that beforehand? You did, but does every single project 100% deliver? They rarely do, despite your best efforts and all of your training. So factor for your own execution risk, that is, that you're part of the problem. In the example here, I'm going to say 20%. So the first risk is my own product or service failing to deliver, and let's say we'll give that 20%. The next risk, and in this case, because we're a marketing services organisation, I'm going to give you an example from the sales side of the house, that the sales execution fails to deliver, and let's give that a 50% probability. Next, just other things that I haven't thought about. Give that another 30%. Then the next risk is that the market appetite is just too low. No matter how good the product or service is, the market's just not there for a product or service like that. Let's give that another 50%, let's say, and another 50%, the final 50% on the risks for the market is there, but they just don't like your product or service, or your client's product or service. Aggregate of all of that is a 200% factor for risk. So you already need 2x just to cover the risks, the downsides. Now let's go upside. And on the upside, we need another factor. In this case, it's a totally de-risked factor. So let's give it another 50%. What we're saying in English is, given that we've already allowed for risks, if it's a zero risk investment, what do I want to get back in return? I'm going to say 50%. So that is, I want my money plus another half in return. I want my money plus another half, even if it's a zero risk conversation, because I'm trying to make some money from this. It's an investment. Finally, what's my risk appetite? And by that I mean, you might as a business take on a few risks. We certainly do. And it could be that you at a particular point in time just don't have a lot of risks in your book, if you like, and therefore you've got a pretty high risk appetite. But you might have lots, or you might be feeling nervous about the economy or the environment or your own capacity or something, and therefore you might have a negative view. In this case, I'm going to say, let's take a negative 20%, saying that, I think I said, yeah, 20%, saying that ignoring the merit of the investment on the table, right now, we're probably pretty full, and so we'll only take on investments that are a little bit special. So let's give it another 20% kicker. The net effect of all of that is that if we add the 200% risk factor and the 50% upside factor, and then we just, in this case, we want 20% more because our risk appetite's a little lower than it normally is. Net effect of that is that we need a 3 times multiplier. Now be really, really careful. That's a 3 times multiplier plus the money. By that, I'm saying if you want me to do $100,000 worth of work, assuming that all the risks are dealt with and that I make a profit, I want to get that $100,000 back plus 3 to make it worthwhile. So therefore it's a 4x multiplier. Now, client, is that really a conversation that you want to have? If that was an angel investor, 4x is utterly reasonable. Utterly reasonable. I've laboured this, but what I'm saying to you is separate the conversation around you as a desperate vendor trying to get business from you as an investor. Fix the desperate business things, create a strong case for change, sell your value really well, and make sure at the core you've got good stuff and it's well priced. Now, if all of that is true, then you're no longer a desperate vendor. They want your stuff. Now you can be an investor rather than a vendor. And as an investor, I want 4x. So I'm going to give you $100,000 worth of work, and when it all works, I'm going to be paid $400,000. Now that's a fair deal. Go sell it. That's step 6. Well, that's it. I hope you got value from that. As I said, I'll give you a copy of the little template in the show notes so you can use it yourself. Don't undersell your products or services when somebody asks you to take a bit of skin in the game. Separate the vendor from being the investor, and I think you'll be served well. I really hope that helped. I got value from clarifying my own thinking, and I hope you got value along the way as well. Lots more lined up for next week. Until then, may your funnel be full and always flowing. Our thanks this week to the person who emailed in and asked me that question that I posed and answered in today's blog. Thank you so much. Thank you to Hannah Sivalingam for your production. Welcome to the team, Hannah, and thank you, Anne, for your previous production. Here's a copy of the template that I referred to. Grab a copy of that if you wish. My name's Hugh McFarlane, and it's been my absolute pleasure to script and record this week's show.